Okay, let's take a look at exercise 9-9. This is a comprehensive analysis, financial statement analysis exercise. And they've given us the December 31st, 2019 balance sheet for Walton Corporation. And these are the only accounts on their balance sheet. Amounts indicated by a question mark can be calculated using the information that's provided. Okay, so we've got cash, we've got property, plant, and equipment, and total assets. So we don't know how much of the difference is accounts receivable or inventory. We also know what income tax payable is, and we know what common stock is, but we don't know accounts payable, long-term debt, or retained earnings, and we don't know the total liabilities and stockholders' equity. Of course, you know that the assets have to equal liabilities and stockholders' equity, so you know the accounting equation has to stay in balance, so you really do know that number. Now, additional information they've provided us is they've given you the current ratio at the year end, the total liabilities divided by stockholders' equity. They've given you that ratio, that's 60%, and the gross margin percentage is 40%. Inventory turnover, which they're computing as cost of goods sold divided by ending inventory, is 10.5 times, and the margin was $350,000. Okay, so requirement A says compute the balance in trade accounts payable as of December 31st, 2019. And here's a hint here. I've hid some of the answers that you have to work through. But current assets are going to consist of cash and accounts receivable and inventory. And we know what total assets are, and we know what property, plant, and equipment is, so we can work backwards and figure out what total current assets are. And then we can subtract out cash, and then all we know is the unknown between accounts receivable and inventory. But then they tell us the current ratio is 1.4 to 1. So if we've got a current ratio of 1.4 to 1, and we're able to calculate what current assets are and what the ratio is, you can solve for the unknown to determine what current liabilities must be. Remember, a ratio is two numbers. One number divided by another number equals another number. Well, if we know the answer in one of those other two numbers using algebra, we can solve for the unknown. Okay? And then we don't know what accounts payable is, but we know that income tax payable is $35,000 and current liabilities are only income tax payable and accounts payable. Okay, so you can calculate by knowing what the current liabilities must be, you can force into accounts payable. So really this problem involves you figuring out what you know and then having to use the ratios and the information that you're provided to calculate what's unknown. Okay, next part B says compute the balance in retained earnings. Well, you can solve this by using simultaneous equation based on what you do know, right? Liabilities given by L, stockholders' equity given by the variable SE, and common stock CS. So liabilities plus stockholders' equity we know equals $452,000, right? Accounting equation, assets have to equal liabilities and stockholders' equity. And then we also know that liabilities divided by stockholders' equity is 0.6. Now, how do we know that? If I slide that over a little bit, there's the 60%, which is 0.6. All right, so then we can figure out that liabilities has to be 60% of stockholders' equity. Again, that's given the information that you have. So if you set it up as 0.06 SE plus SE equals 452,000, you can now solve for stockholders' equity. Okay, stockholders' equity and common stock combined is what makes up stockholders' equity. So we can solve for retained earnings once we know stockholders' equity by subtracting the common stock portion, which is given to the left of my mouse. Okay? Okay, then C says compute the balance in the inventory account as of the end of the year. And we assume that the level of inventory didn't change during the year. Okay, now again, I equals inventory, S equals sales. We use COGS to stand for cost of goods sold. Gross margin rate is GMR. Gross margin is given by GM. So the gross margin rate is equal to the gross margin divided by sales. And we know that 40% is equal to 350,000 divided by S. How do we come up with that? Let's slide this over. There's our gross margin percentage, 40%. And the 350,000 is gross margin is given to us. So we can then back into sales, right? If 350,000 represents 40% of sales, then 350,000 divided by 40,000 will get you sales. Now we take the sales minus the gross margin, which is given to us, come up with cost of goods sold. Remember that inventory turnover, let me slide this over by the way, so you can see it. There we go. So 350 divided by 40% gives you 875. That's sales. Sales minus gross margin. That now we know how to come up with cost of goods sold because we've been given gross margin. We calculated sales. So then we just have to think through the inventory turnover, which is cost of goods sold divided by inventory. And again, they've given us two of the three numbers. There's the 10.5 of inventory turnover. So if we just work through the algebra, we can determine what the balance in inventory would be. Okay, so there's some hints to get you through this challenging financial statement analysis and ratio problem.